Investors, every now and then, some new trendy investor craze stock or ETF gets hyped up as the must-have, buy now or forever be broke investment. The first examples that immediately come to mind, the infamous tattooed chef or the dividend ETF, QYLD. And now there's a ridiculous ETF out there that I'm warning you to stay away from. It's the YieldMax Tesla Option Income Strategy ETF, ticker symbol TSLY. But before we get to it, if you're new here, I'm Ari, your dividend investor here on YouTube, looking to ensure you are keeping up to date with all the need-to-know economics and armed with the latest dividend stock ideas. But with that, let's get to talking about TSLY. So over the last couple of years, some really cutting-edge option strategized exchange-traded funds hit the market and not only swept the entire market in terms of returns, but just continued to perform very well, like the JP Morgan Premium Income ETF, ticker symbol JEPI, and its tech sibling, the JP Morgan Nasdaq Premium Income ETF, ticker symbol JEPQ. Now with both of these funds, they have 120 and 82 holdings within them respectively, with holdings like Amazon, Adobe, and MasterCard and JEPI, or Apple, Microsoft, and Google within JEPQ's top 3 holdings. And as you know, investing into a basket of stocks is always safer than investing into an individual position. Moreover, such funds make their stock selection based on risk-adjusted stock rankings, while also using an option strategy to generate and distribute monthly income, which have proven to be a massive success, as we can see since their dates of inception, with a $10,000 investment in JEPI returning $4,876 to its shareholders and JEPQ returning $1,394 to its shareholders since its inception. However, this video is not about either of these two ETFs. It's about the YieldMax Tesla Option Income Strategy ETF and why you need to stay the heck away from it, or why I think you should anyway. But before I make my case, if you find today's video useful or helpful to you at all, tap on that thumbs up button so YouTube will share this video with more dividend investors, and together we can ultimately spread the message to more investors. Now, where were we? Yes, the TSLY ETF here, to avoid at all costs. And the primary reason, it immediately strips away a dividends investor from safety and reliability, given it's solely focused on one company and one company only, Tesla. Which, not for nothing, is already a pretty volatile investment. And when it comes to TSLY, well, we could see this performance. Right out of the chute, it shot up to over $20 per share, but yet to find its way back to such heights, trading for $14 and something changed these days. And now, why would you want to get invested into such a fund with a lack of performance? Well, as I've heard through the grapevine, it's the fund's dividend yield coming in at a staggering 30.44%. But it is this very dividend yield that makes me question the heck out of this ETF, especially as we can see over time the dividend payout started out so strong at $1 per share, then weakened to about 90 cents per share, and then to 80 cents per share before a low of 43 cents per share, while then rising back slightly here, but yet to maintain any sort of strength. But what gives, and how does this YieldMax ETF even work? Well, it seeks to provide income and capped gains on Tesla stock through a synthetic covered call strategy. That essentially means that there's a purchase of an additional long call option above the short call to create a short call spread. Now, I want to say one thing that makes this even worse off is the fact that it's actively managed. The ETF, that is. That means more human error, and oh yeah, expenses will be higher as well for an actively managed fund, with an expense ratio coming in at a whopping 0.99%. That means you're paying roughly $99 for every $10,000 invested, compared to, say, your JEPI, which is at a much lower expense ratio of 0.35%, or even with SCHD, that will give you more safety, and not only safety you're looking for, but deserve as a dividend investor, with a 0.06% expense ratio. But now here's where it really gets interesting, because let's face it, performance means everything, right? Well, if we compare some of the ETFs we just mentioned, so let's take JEPI, JEPQ, SCHD, and a personal favorite of mine, VTI, and this new must-buy bankrupt yourself ETF, TSLY, though only recently introduced to the market, is the lousiest performer of them all. So here's the deal when it comes to TSLY, at least how I see it in a nutshell. If you invest into this fund or any YieldMax ETF similar to it, like the Apple, Nvidia, Amazon, Google, Meta, or even any of these other option income strategy ETFs designed to sell you on the allure of getting rich quick, you are simply putting yourself at risk in terms of a lot of volatility, relying on active management, which will cost you a hefty penny and more likely to get shortchanged as you walk away with losses, wishing that you just listened to the simple suggestion of staying the heck away from TSLY. Whereas the YieldMax team will be there to say,
what an idiot! Oh, what a loser!
So you're far better off, in my opinion, sitting back and investing into an ETF with a lower yet reliable and consistent yield that will actually continue to generate you some serious income. Of course, there is also always Vegas if you're looking for some more fun. Now, that's my opinion, and you're of course entitled to your own, but I'd certainly like to know about it, so definitely go ahead and drop a comment down below to let me know all your thoughts on TSLY. And if you enjoyed this video, let me tell you that you're gonna love this one right here. But before you go and tap on it, click that thumbs up button for me, and of course, subscribe to never miss a single video.